Hey YouTube, Jason here with Day Trading Fearless. Welcome back to my channel. If you're new, welcome. Make sure you guys hit the like button and also subscribe. And all these option videos are sponsored by myself. So these are the weekly trade zones for the S&P Emini futures. $50 one-time payment for a lifetime subscription. I've been doing these for about 7 or 8 years now. And every weekend I send you all these trade levels. Again, $50 only. Go to daytradingfearless.com or click the link down below in the description. And also make sure you check out my Patreon page at patreon.com/daytradingfearless to follow along with my trading portfolio. So, with that being said, let's jump into the option video course, and I hope you guys enjoy it. And thank you for watching. In this video, we're going to talk about long call butterflies. So, market opinion for a butterfly is bullish, bearish, or neutral. And you will always pay a debit for this. What you want to do is short 2 calls at the middle strike and be long 1 call at the lower and the upper strike prices. The upper and lower strike prices, which are the wings, must both be equal strike distance from the middle strike body. If they are not, then this is called a broken wing butterfly, and all the options must be the same expiration. You will pay a debit for this trade. So think about this, okay? Easiest way to understand it is look at a butterfly, right? You're looking at the butterfly, you have the body, and then you have the wings to the left and the right, okay? You want to sell the meat, right? So you're selling options, collecting that premium of the body, and the wings, you're buying calls, okay, to give you protection in case price moves beyond those wings. And also another way to really think about this is almost kind of like a potential lottery trade where they're not very expensive, but if you think price is going to be somewhere within 30 or 60 days or 2 days, whatever, and we land on that exact strike price of the options you sell, that is the home run trade. So, current stock price is $20. Buy 1 XYZ October 22 call. You then sell 2 XYZ October 20 calls, and then buy 1 XYZ October 18 call. You will pay a 50-cent debit for this entire trade. Now your max loss is the 50 cents debit you pay, but your max profit would be $1.50. Your break even is if the stock closes above $18.50 and or below $21.50. Now think about this, right? We have $2 strike here, $2 strike price here, and if you add the $1.50 plus the 50, that equals the $2. So an example is you will, and not Yao, but you, it's meant to be a you, will want to sell 2 October 20 calls, the body of a butterfly, okay, to collect premium, and then you want to buy 1 October 22 call and 1 October 18 call, the wings of the butterfly. You will pay a debit for this trade. And as long as the stock is trading at $20 by October expiration, you will collect the max profit potential. Your break even on this trade is above $18.50 and below $21.50. So let's take a look at a trade. So on Thinkorswim, go up to spread, go to butterfly, okay, and let's go out to May. Okay, and let's look at the May butterfly, okay? Well, right now we're at 41.70. Let's say, hey, I think we're going to be at $40 exactly come May expiration. So I'll come over here and I will buy this butterfly, right? You usually never want to sell butterflies. You always want to buy them, okay? And you can either do the calls or the puts. So in this example, what we'll do is we'll do a put one, okay? Because we think prices can go lower, okay? And we're going to close exactly at $40. So what we're going to do is we're going to click the ask and we're going to go to the wing. Let's go 41, 40, and then 39, right? And if you look, we're buying the 41 wing, we're buying the 39 wing, and then we're selling 2 of the 40 wings. This trade's going to cost us 9 cents, okay? Or $9. Well, let's break this down. Our break even is from 39.09 to 40.91, right? Our max profit is $91. Our max loss is $9. Okay. Now, there are 4 legs to this, right? You have 4 options, so you're going to have to account for in and out of, but options are so cheap nowadays, it really no longer makes a big deal, right? Because you're only paying $2.60. Remember, a year or 2 ago, they were charging $9 for just one option, right? And that was for one leg. So it changes the whole profile to where it's good to do it. But your ultimate is you want price to close directly at $40. If it does, you will collect the full max profit of $91. Now, if we close at 41, you're going to lose, but you're only going to lose $9. So it's kind of like you're saying in the future, I think we're going to close exactly at this price. It's a long shot because who knows? I mean, that's 28 days left, but guess what? If you are right and we do close at that level in 21 day or 28 days, you will be paid $90 on the $9 bet. So that is a long call butterfly / put butterfly. If you could do either the long calls or the puts, I should have put that in here, but it's essentially the same thing. You always want to be a buyer of these. So that's it for the long call butterfly video, and we'll talk to you on the next video.